Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, October 23rd, 2019. For the 7th week in 8, we've actually seen net new money come into the conventional fund business, this time to the tune of about $18.1 billion, but the headline number is a bit misleading. We get to that in detail. Investors kept a close eye on the economic releases that have been out. We've had quite a few that have come out lately. Obviously, Brexit, Sino-American trade negotiations that are going on. But the main focus for the last week or so, and probably the last 2 weeks, has really been Q3 earnings announcements. And despite having lowered expectations and some analysts saying, listen, of course, companies beat their estimates. Well, 80% of the 168 of the 500 S&P 500 constituents actually have beat their earnings estimates. And so this has really been quite a good start to the earnings season. But as we will see here later on, it hasn't really panned through to when we're talking about flows into equity funds. I told you there was $18.3 billion that we've actually seen flow into the conventional fund business. But truly, what the problem has been is that most of this has been going into money market funds. For the fund flows week, the Russell 2000 price only index actually returned about 1.82%. It posted the strongest returns. While on the downside, we saw that the Dow Jones Industrial Average price only index actually lost about 0.62%. Not a big number, but this was after Boeing and J&J actually came out with some disappointing earnings news and actually some issues with Boeing, perhaps not telling the whole truth when it came to their new jet that was having problems in it. And Johnson & Johnson also had some discouraging news with a batch that had some asbestos in their baby powder, and so they kind of got dinged for that as well. So basically, when we're taking a look at this, we're going to go ahead and take a look at the macro groups now and see how the news actually panned out to fund flows. We see that on the equity side, about $4 billion flew out of the conventional fund business. Taxable bond funds, however, saw about $3.2 billion net new money coming to that group. Muni bond funds has been a story for a long time now. Again, net inflows $1.2 billion, but as I was saying a little bit earlier, we saw that money market funds took in $17.7 billion. So while we've seen all these nice flows into the conventional fund business, really it has been a tale of two cities where we've had a lot of flows going into the ETF side of the business, and then we've seen a lot of outflows, especially with equity funds, out of the mutual fund side of the business, although that's flipped on its head when we talk about taxable bond funds. Anyways, let's go ahead and take a play-by-play and see what happened in the equity mutual fund arena and get a general idea what's been going on with that. Equity funds for the third consecutive week actually have plus side returns, this time to the tune of 0.36%. 36th consecutive week, though, that we've seen outflows, this time to the tune of $4 billion. And how it broke out is domestic equity funds lost about $2.9 billion. 37th consecutive week, they've seen outflows, but again, they had a nice return, 0.30%. Not bad for a 1 week return, also for the third consecutive week, by the way. And non-domestic equity funds lost about $1 billion. It's the 10th consecutive week they've seen outflows, and their return was 0.48%. That's the third consecutive week they've seen plus side returns as well. If we broke that down a little bit in more detail, we see large cap funds lost about $2.4 billion. Small cap funds handed back about $492 million. International equity funds, though, on the other side, lost about $800 million in global equity funds, so about $239 million in net outflows. Year to date, this group has given back about $183.4 billion. That's huge. Let's go ahead now and take a look at the ETF universe when we talk about equity funds. So basically we saw, basically we saw equity ETFs for the second consecutive week only take in about $104 million. Very low number. So, So the kind of story here is, yes, we saw outflows out of the conventional fund business, but really on both sides of the fence, whether it's authorized participants or the normal retail investor, people are very cautious getting into the market despite having pretty nice returns on a year-to-date basis. The big attractor of money this week was iShares Core S&P 500, a total U.S. market. ETF saw about $544 million come in. iShares MSCI Japan ETF took about $468 million. And on the downside, we saw iShares Core S&P 500 ETF lose about $1.1 billion, and the iShares QQQ Trust, one ETF, lose about $682 million. So that actually basically brings us to the fixed income side of the arena, where we can talk a little bit more about some solid flows that we saw on both the instruments, both funds and ETFs. Let's first start with the fund side of the business. Fixed income funds for the third consecutive week saw inflows about $3.2 billion. The third consecutive week they had plus side returns, this time to the tune of about 0.18%. And the tractors of money was the corporate investment grade debt funds. They saw about $2.1 billion come into their coffers, and flexible funds saw about $368 million come into their group. On the flip side, we saw that corporate high quality funds lost about $13 million. It's the only real net outflows that we were able to put together. Year to date, this group has attracted $127.3 billion, and that's where we see people putting money to work. Obviously, it's not in equities. People are feeling that the equities are a little bit too dear in price, and they're just not willing to pay for that anymore. And I think think the risk is on. Well, that goes ahead and brings us to our fixed income ETFs. Let's go ahead and take a look at that group. Fixed income ETFs took about $3.1 billion. Fifth consecutive week they've seen net new money come into that group. Fourth week in 5, they've been plus side performance. Average return for this group is about 0.10%. And at the top of charts, we see that the iShares iBoxx High Yield, and it'd be the dollar high yield corporate bond ETF, HYG, saw about $522 million come in to that group, and the Spider Bloomberg Barclays High Yield Bond ETF, J&K, saw about $239 billion come into that fund. At the bottom, we see the iShares Short Treasury Bond ETF, SHV, lose about $1.9 billion. And then we saw the Spider Bloomberg Barclays, the 20-year Treasury Bond ETF, TLT, basically lose about $84 million. Not a lot to write home about on that one. So basically that brings us now to our next group, and that is muni bond funds. And muni bond funds for the 42nd consecutive week, I told you they've been on a run, took in about $1.2 billion this week. Second consecutive week, though, that they've seen negative performance, this time to the tune of minus 0.27%. And what we saw as far as detractors of assets, general insured muni debt funds, once again, basically saw about $715 million in net new money coming to that group, and high yield munis took in about $355 million. And then if we take a look at the ETFs, muni bond fund ETFs, we see that for the third consecutive week, they took in net new money about $222 million. Now, if we look at the munis and include conventional ETFs together, they've taken $73.5 billion. This is an actual phenomenal amount if we start comparing it to equities and even taxable bond funds. And the size of the original total net assets under management, we see that they proportionally outdrew just about everybody in all the groups, with the exception of money market funds. And that brings us to our last macro group, and that is money market funds. Let's go ahead and see how that group panned out and how they took in money. As I told you, they took in money for the 7th week in 8, this time to the tune of $17.7 billion, and how that panned out was taxable money market funds took in about $18.3 billion, with institutional money taking about $13.5 billion, and retail investors putting about $4.8 billion back to work in money market funds. Tax-exempt money market funds, with all the money kind of going into the taxable or tax-exempt muni bond funds, it's got to come from someplace, so a lot of it's coming from money market funds on the tax-exempt side. So about $548 million in outflow. Year to date, this group has taken in $378 billion, and that has been quite a feat for the money market funds. So a lot of money sitting on the sideline, I think ready to get back to work, and I think investors are just confused on where they should be putting money. Well, we're going to keep an eye on the Fed meeting coming up next week. I think that's going to be all hands on deck watching that one to see if they get another 25 basis point cut. Then we're going to obviously keep our eyes on continued reporting of the Q3 earnings season. That has been, again, going fairly well. We've seen some good numbers out there. They've been revised, but they've been beating those revised numbers. And, of course, all eyes will be on the trade negotiations with China as well. So if I haven't done a deep enough dive for you and you'd like to do a little bit more research on fund flows, you can go to our site at www.lipperusfundflows.com. Or please join us next week when one of our analysts will be back on talking about the fund flows trends for the week. Well, that's it for me. My name is Tom Roseen, wishing you the best in wealth planning and creation.